Hold on. Hey everyone, we are live and thank you so much for joining us. I apologize for a little bit of technical difficulties getting started there. LinkedIn rejected us at first, but we are live. So hello LinkedIn, hello YouTube, hello Facebook, hello Twitter. Thank you for joining us for another Mortgage Leadership Outlook where we connect with the biggest and brightest minds in our business, leaders such as Allen Shayanfekr. Did I get it right, Allen?
Yeah, you got it. It's okay.
Oh my goodness.
Everybody struggles with that one.
Well, I'm glad actually I got it right. I'm glad actually that you were able to join us here. We're super excited to have you on here. You know, and there's as we've had a lot of guests that have been talking about how they've been dealing with liquidity crisis, how they've been dealing with, the new norm and working from home. I think you have got an interesting story to tell, and we're going to get into that. But talk to us a little bit about Allen. Tell us a little bit about your history and how you got actually, into the real estate finance business.
Sure. So hello, everybody. Thank you for having me today. My name is Allen Shayanfekr. I'm one of the co-founders and the CEO of Sharestates.com. Sharestates is a marketplace lending platform. We basically built a marketplace or a software that connects real estate investors and developers with passive investors that would like to deploy some capital into real estate projects, trying to democratize the real estate investment and make it more accessible to a broader audience of investors that's comprised of individuals as well as institutional investors. A little background on me. I actually went to law school, spent 3 years, graduated right around 2012. Wasn't quite sure what I wanted to work on at the time, and ended up working with my two co-founders today, who had been in the real estate industry for about 20 years now, but they got started back in 2002, 2001 as principal investors, developers themselves. They eventually opened up a title insurance company. So coming out of law school, I started working with them on the title insurance side of their business. Spent about a year with them, taking them from what was a 3-state licensed footprint to a 34-state footprint, before realizing that, I wanted something a little bit more interesting to work on, something that I could be, the principal of, the owner of. And right around that same time is when this broader concept of marketplace lending really started to take off. So we looked at companies that were doing consumer finance and consumer lending, business finance, student loan finance, auto finance, pretty much everything under the sun. But nobody was really doing it in the real estate sector. So we decided to build a real estate platform and leverage the book of contacts my partners had in the real estate industry.
So it's interesting. So, and when you guys got started, it was basically really people started talking about crowdfunding, and the crowdfunding concept just started coming out. And really, actually, I'm gonna admit, you guys were one of the first people actually to really talk about that. And I really didn't understand it at first. I have a feeling there's a lot of people actually that don't understand actually that concept, and that's still a core component of what you guys do, right? I mean, it's crowdfunding, right? So talk to us.
So crowdfunding's a big buzzword. It was first implemented. The concept was first implemented by the Jobs Act in 2012 by President Obama. Loosely, the definition of crowdfunding is having 2 or more people come together to fund a project. What the asset class is doesn't matter. It could be real estate. It could be pretty much anything you could imagine, right? The problem is that everybody thinks that this concept of crowdfunding is new. The rules and regulations around it are new, but this concept of syndication, having 2 or more people participate in investing in something, goes back decades, if not centuries. Just think about a basic, limited liability operating agreement. You and your buddies could get together and start a company. You each put in some money. You've technically just crowdfunded some sort of an investment.
So, and you guys are doing this because this was done actually, where people are saying, okay, well, I'm going to crowdfund my business. I'm going to crowdfund, I have an idea for some wacky invention, but you guys brought it to real estate. Now, at that time, what other players were out there offering this kind of like crowdfunding for real estate?
Yeah, so crowdfunding really started to become hot with non-investment platforms. So you had companies like GoFundMe, various other platforms that were more, charity-based or donation-based, or you had platforms where you could technically crowdfund into a company that was looking to get a new business idea off the ground, but because the Securities and Exchange Commission laws did not allow for any sort of financial give back or financial incentive to the investor, you got more cool, like gimmicky stuff. So like you could get a mug, or if you helped finance a movie, your name would be listed in the credits, or you might get a t-shirt with the company's logo on it, just, funky stuff like that. Once the SEC loosened the rules and regulations, you started to see other companies using this crowdfunding concept for other investment classes. So, Lending Club and Prosper were two of the first companies that did this through older regulations and through something called an S1 offering. So they actually started funding consumer loans to individuals. You could go as a borrower to their website, borrow $25,000 to do a home renovation, to buy a car, to finance medical bills, whatever it was going to be. And then from there, it started getting into other businesses like On Deck, for example, is another company that started doing this concept for business loans. And then we shortly followed thereafter with real estate loans.
So, previously, to do something like this, you basically had to be an accredited investor, right?
Yeah. So what happened was the SEC had this framework under Regulation D, Rule 506B, that allowed you to, as a company or as an issuer, go out and raise money strictly from accredited investors. You could not publicly advertise those, so it had to be a relationship with somebody that you had, or a friend of a friend, some sort of pre-existing relationship. You couldn't just put an ad on TV or buy a billboard ad and raise money. With the Jobs Act, several changes were made to that. So they added Rule 506C, which now allowed for public solicitation and advertisement for these private offerings, which again was still limited to accredited investors. There was Title III of the Jobs Act, which created crowdfunding for non-accredited investors. And there was also Title IV of the Jobs Act, which created this Regulation A+ concept, which was also targeted towards non-accredited investors.
Interesting. So here you created actually the funding source, which is often the big problem, from using this like crowdsource concept. Give us an idea of the profile of investors that were putting their money into Sharestate projects.
Sure. So when we first started, we started very much like what most companies do. We went to friends and family. It was a new concept, and admittedly, we thought it was going to be a lot easier to get this thing off the ground than it was. We had this idea in our minds that, if you build it, they'll come. I mean, who doesn't want to invest in real estate? If you could spend $1,000 and participate, why wouldn't you, right?
Yeah.
We realized after we built the platform and kind of took our website live that it wouldn't be nearly that simple, right? You're going out into a broader audience of people that don't know you, have never heard of you, have never heard of your company. The company itself has a very limited online track record, so there isn't a whole lot of information that you can really look up on it. And you're basically asking people to give you money as an investment, right? So, if somebody you don't know kind of approaches you with something like that for the first time, you're going to be skeptical. So we had to pivot a little bit. We realized that, in order to really build a platform that's going to have hundreds of thousands, if not millions of dollars flowing from individual investors, we first had to make the platform look legitimate. And the best way to do that would be to scale the business, give it a track record, give it a history, show performance. And the best way to do that would be to go to institutional investors. So back in 2015, we had to pivot for a short time and really focus our attention towards bringing in institutional investors, which helped build our track record. And then eventually we brought back in those crowd investors. So today we're about a 60-40 split, with 60% of our capital coming from larger institutional partners and 40% coming from the crowd or the syndication side of the business.
All right, so here we go. Let's fast forward to 2020, where all of a sudden the credit markets just seized up, and funding sources died for so many deals, as we saw, in March, end of March. People talk actually about specific dates, but so what did that mean for Sharestates? So what happened next, to your ability to fund deals in
Sure.
the end of March?
Yeah, so we had grown quite a bit over in the 5 years that we launched our business. So we formally launched in 2015. So we're about 5 years into that operation, and since then we funded about $2.5 billion in loan volume. And leading right up until March, we were closing just about $100 million a month. Our business model is a little different than your typical financing model because we were all about diversification of capital sources. This concept of having a large marketplace of investors, institutions, individuals, family offices, every type of capital you could imagine. But the one key common theme was we were diversifying. If you look at who our competitors in this space were historically and how the business normally works is you've got, a standalone fund, somebody who's gone out and raised some amount of money. It could be 30, 40, 50 million. It could be a billion, whatever the number is. You have one source of capital, it's predefined, you've already raised it, and now you're focusing on either lending or investing or whatever that fund is going to do. With us, we were working with hundreds of investors. And the thesis there, the idea there for us was if we diversify our capital sources enough, then we should be able to withstand any sort of economic downturn. Now, that doesn't mean that we won't feel it. Of course, everybody feels it, but the business doesn't stop, right? And that's where we are today. We thankfully have diversified our capital sources enough through the years that, even though we're not doing, nearly 100 million a month in volume now, we're still able to operate. That means that we can continue to fund draws for our borrowers. That means we can continue to service those loans. We've built a balance sheet. We've built a servicing book with servicing revenue that's coming in that allows us to, retain our employees, continue providing services to our existing investors and to our existing borrowers, as well as close new loan volume. That being said, of course, we felt it just like anybody else. We had investors that unfortunately had to go on pause while they were figuring out internally what they were going to do in terms of next steps, whether they were going to continue investing, they were going to potentially shut down. Nobody really knows. Thankfully, I can say now 90 days later that I'm confident that all of our investors are going to, well, all but maybe one, are going to survive on the institutional side. And thankfully on the crowdfunded side or the syndication side, we still have plenty of capital coming in the door from both smaller institutions as well as retail investors.
Fantastic. That's good. Good to hear. Good to hear. It's glad to hear. We only lost one funding source there. So we got some questions from the audience. First, we're going to go to YouTube. We got Kevin Shane from YouTube is saying, do individual investors have the same terms as large investor funds when they're invested in the same loan? Good question. I love that. And John, I see your question there. We're going to ask your question about values and also volume. But tell us, answer Kevin's question if you don't mind.
Yeah. So Kevin, Kevin works for us. So I'm just putting that out there. He's photobombing right now, just dropping in a fun question for me. Our institutions and our retail investors invest on the same terms. If anything, I'd say that our retail investors probably receive slightly better terms than our institutionals. And there's a reason for that. So what I mean by that is typically the interest rates that we deliver to our investors on the retail side with individual investors is typically higher than the institutional world. And the reason for that is simply supply and demand. In the institutional world, you have large asset managers and investment funds that have gone out and raised a ton of money. They've gone to big banks and they've taken warehouse lines. So they have large pools of money that they need to put out and they're all competing against each other. So when you're looking for assets to buy, that's going to cause yield compression and just, driving rates down. So a platform like us that's selling its loans is going to look to sell them to those institutional partners that are going to give us as a platform potentially, a larger spread, meaning we make more money. So if I originate a loan at 10% and I can sell it to an institution at 6% or 7%, we're going to generally opt to sell it to that institution at 6%. Now, we also do need to balance that with our need to diversify capital sources. So because there's less capital typically flowing on the retail side, meaning smaller check sizes. There's obviously by volume a larger number of people and investors, but just smaller investment sizes. That for us, again, kind of keeping with the pace of, diversify, even though we make less money with those investors because we have smaller spreads with them, we want to have those investors on board. We want that diversification. So we actually incentivize those investors to participate more with higher interest rates. So we'll take a smaller spread, pass a higher rate of return to those investors, to entice them to get involved.
Interesting.
But otherwise, credit quality of the loans and everything else is the same.
Wow. All right, so let's so we know actually on the investor side actually how you guys are doing. How about the deal side? As far as the from John Coaster asked how much has volume dropped off?
Our volumes dropped off probably about 80 to 85%. So, and that's a function of a few things actually. So borrower demand is definitely there. If anything, that's gone up. The primary driver, I think, for borrower demand going up is because there have been many competitors of ours or peers of ours in the industry that did not diversify capital sources, which ultimately has left them unable to do business right now. So our space over the last 5 years has gotten increasingly more crowded. We've had a ton of competition, which again has caused yield compression and a number of other credit changes over the years. But as a function of everything that's happened, those lenders that are now exiting the space have created more demand from us from our borrowers. So guys that we previously were not doing business with, who may have been going to one of our competitors, are now coming to us looking for financing. With that being said, of course, we have seen capital drop off on the other side. So a lot of the capital that was in our world was coming from the institutional side. So I mentioned before, we've been historically ballpark 60-40, 60 from institutions, 40 from individuals. Most of that institutional capital has been reliant on either warehouse line financing or securitization financing, both of which have been in shambles really since the COVID-19 pandemic started. So most of the capital that has stopped flowing, actually, believe it or not, has been the institutional capital, whereas the retail capital and smaller unlevered institutional capital that's participating on the crowdfunding side of our business or syndication side is still flowing. So, just as a function of just capital availability, we've seen a drop off. And then also just smart business planning, right? I mean, we knew going into this 90 days ago that, there was likely going to be an uptick in delinquencies. We were going to have to place more of an emphasis on focusing on asset management and making sure that we're servicing our loans, answering investor questions, just a whole host of issues that were going to come up that we needed to shift resources internally for. So that's exactly what we did. We shifted resources from our sales and marketing team, from our processing, post-closing, closing, underwriting teams to asset management, just preparing our team, having more people ready to reach out to borrowers, answer their questions, potentially help them, execute a forbearance agreement or whatever that might look like. So it's really been a combination of those two things.
So you're saying that people that work for you involved in marketing are involved in other tasks. So you have actually, and I don't know if you had any kind of furloughs or anything like that, but you basically had to take actually people and say, listen, I know your job was this, but now you're going to be doing this.
Yeah. So we had a decision to make. I mean, we number one, we knew we needed more resources on the asset management and loan servicing side. And we knew that we were going to be doing reduced volume. We had 120 people on staff, and we were trying to save as many jobs as possible. Yes, the government put out stimulus in the form of PPP loans and various other products, but we just didn't know if we were going to get approved, if we were going to qualify. We didn't know if we were going to be able to keep people on board if they weren't doing anything. So we had to repurpose those staff members as quickly as possible, cross-train them, and thankfully, we still had to furlough some people, but out of 120 person staff, we ended up furloughing 20 and keeping on board another 100. So we saved far more jobs than we would have otherwise. So
that's great. So physically, you guys were all headquartered together. Like you guys showed up to an office every day, right?
Yeah. No. So we had one headquarters that was in Great Neck, Long Island. And then our IT and technology teams were offshore.
Interesting. So the in the office, and now everyone's working at home. Like, what was that transition for you guys to go from working in the office to now we got to actually all shift and everyone work from home?
It actually wasn't that hard. It's funny. So when we were building our business, every time we onboarded an institutional investor or really any investor that was doing any sort of due diligence on us, they always had a laundry list of questions and documents that they would ask for. Two of the documents that would come up all the time, and this is probably from my lack of experience at the time, but two of the documents that would come up all the time that I would always say to myself, okay, we're never going to need these things, were a disaster recovery plan and a business continuity plan, which basically just kind of cover, what are we supposed to do if there's some sort of a disaster, natural disaster, or we have business continuity interruptions. And I always laughed to myself and said, what are the odds we're ever going to need these things? Sure enough, we needed those things. So thankfully, we had the framework for what we needed to do in place. Thankfully, we had built our own proprietary technology from the ground up. So everything was cloud-based. You can log into our system from anywhere, from home, from Alaska, Hawaii, it doesn't matter. So it was really just a matter of transitioning people to working from home and just trying to keep some semblance of community by doing, weekly happy hours with our staff on Zoom or trivia nights or whatever it is so that people could still see each other, interact with each other, hang out with each other. But other than that, I mean, the business has been working pretty fluidly, thankfully.
It's funny. We looked at those things and we say, "Oh, pandemic, riots. Why do we have to worry about that?" And here we are, man. It's insane. It's crazy. So you guys actually made that smooth transition. All right. So let's talk shift to talk about business, because a lot of people actually that are watching it, they're most of actually our audience are residential originators, and a lot of them work with business owners, so they come across deal flows like this, but I feel like most of them are ignoring it. Talk to us about actually, where our audience can find opportunities, to even in today with what's going on with, with our pandemic that we're still dealing with.
So if you're talking about the borrower audience,
yeah.
My partners and I talk about this all the time. So smart money, I don't know what the exact phrase is, right? But you kind of hear something loosely along these lines, right? But smart money is standing on the sidelines when everybody else is investing, and investing when everybody else is standing on the sidelines.
Yeah.
We, thankfully, our business model has mostly focused on catering to seasoned speculators and developers as opposed to like first-time borrowers. So we're not, for the most part, dealing with like the doctor or the lawyer who has a day job and who's fixing and flipping a house on the side. We're dealing with the guys that are doing half a dozen to a dozen projects a year, possibly more depending on the size of those projects. So we've had a ton of our borrowers actually waiting on the sidelines with dry powder, with cash, just waiting for, as horrible it is to say, some sort of a downturn that would create an opportunity for them.
Yeah.
And the sad reality is that, a lot of people have probably lost their jobs. They need capital, whatever that source may be. We've had these stay-at-home orders where you have homeowners that are unable to leave their house. They're staying at home. It almost presents a perfect opportunity for borrowers to cold call. You're going to have people picking up your calls. They may or may not, need to sell that property, that home, whatever it might be. They might need access to capital, and there's an opportunity for those who have capital on the sidelines to actually invest at a better cost basis today than they would have paid, 90 days ago. So there is a ton of opportunity out there. It's just a matter of, were you financially prepared to make this an opportunity, not a problem? And if you were, now it's just executing. You've got to have some sort of a game plan or some sort of a team that can sit there, identify, where you want to be investing, and set up a call center. Just make phone calls.
Fantastic. So what kind of properties do you guys look for to fund?
So we fund most types of properties. So about a third of what we fund is residential 1 to 4 family. That's all investor purpose. We don't do anything consumer related. Yeah. Another third is approximately another third is small multifamily in the 5 to 25 unit bucket up in the Northeast. So New York, New Jersey, Connecticut, Pennsylvania. Once we get out of the Northeast and the cost per unit goes down a little bit, you start to get into slightly larger unit count properties, for example, in Memphis, Tennessee, Atlanta, Georgia, et cetera, where you get these garden style apartment complexes. You can get up to 50, 100, 150 units. And then we also fund small mixed use properties as well. That's like your typical urban infill stuff, retail on the ground floor, and then apartments, residential use up above. And then like maybe 5% of what we fund is true commercial. So pure office, pure retail, industrial, warehouse, hospitality, that sort of stuff.
I'm sure that has to feel very good that it's only 5% now.
Yeah, no. So we've always stayed away from retail and office, and I think that's definitely what's hurting the most in this market. Residential and multifamily, I mean, the reality is that people will always need a place to live. There is a shortage of housing. That has not changed. What's made residential real estate a little difficult has been these bans on eviction, with courts being closed, and many local and state officials putting temporary bans on being able to evict tenants. You're basically, it's a tough pill to swallow. It's a very fine line too, right? Because on the one hand, you're telling landlords that they now have to subsidize their tenants because those tenants are not going to pay if they can't get evicted. Not all of them, but some of them. But at the same time, there is a global pandemic, and some people may be unable to pay their rent. So what do you do? I think unfortunately, I don't want to make this a political conversation, but the government had to act quickly to get some sort of program and stimulus in place. They moved faster than they've ever had to move before. They got programs executed and in place. Could they have been better? Yeah, but hindsight's always 20/20. And there was a balancing act that they needed to do there between, getting a program out and available to the people that needed it fast enough, while also at the same time trying to help as many people as they could. So could they have taken extra time and figured out a better way to implement these stimulus programs? Probably. But if they had taken an extra month, God knows what would have damaged, what kind of damage would have been done in that extra month that it took them. So it's stuck between a rock and a hard place. So.
It's unfortunate. Listen, 2008, they didn't act quick enough, and everything just fell apart. The servicers collapsed. Everything just really was just an unfortunate situation. And this is a situation where it had nothing to do with the financial services that we were providing, nothing to do with the mortgages, had nothing to do with actually, the products that the industry was putting together. So this was a completely external, factor that came into it. So yeah, I think actually was it the best? No, but something, we needed to do something, and I'm glad actually something was done rather than waiting. So, what does the future look like for you guys? Like, and why is it a good time for the brokers that are watching this to be working with you guys?
Yeah. So, thankfully, our company will survive. We were built the right way to survive this type of a downturn. How quickly we get back to business, I don't think we'll ever get back to business as usual. I think it's a phrase that's thrown around a lot, let's get back to business as usual. That's going to take a significant amount of time. It's not going to be, in the next few months. You're talking years for that to happen. But as far as, getting back to business, period, that's starting to happen now. So I think, at least for now, the worst is behind us in terms of, the country panicking in terms of, what's going to happen to our economy. How's the market going to behave? Is the market going to tank? There's been a ton of stimulus that's been pumped into the market that's somewhat stabilized things for now. I think we're going to have to continue pumping stimulus into the market because we do have a ridiculously high unemployment rate that's not going to go back down to below 5% anytime soon. And we still haven't seen the reverberations of what that's going to mean for the economy long term. That's going to take, this is macroeconomics, it's super complicated stuff, right? But that's going to take months, if not, close to a year to really see what the impact of that's going to look like. That being said, for the time being, I think people have had time now to digest what's happened. The panic has subsided to some extent, and that is now allowing capital to slowly but surely start flowing back into the marketplace. So the securitization market is slowly coming back. Securitizations are getting done. mostly privately, but still nonetheless getting done. Warehouse lenders and bank lenders are now starting to come back to the table to finance institutions. And those are, two of the first steps that need to happen. Once that happens, asset managers and fund managers can now go out and either start deploying capital that they have already in their war chests, or they could go out and raise new additional capital to then leverage with, bank capital and securitization capital. And it's a process. So even from when our government officials say go, you can now go back to work, you can reopen. There's going to be a 30, 60, 90, 120-day lag between that and when capital really starts flowing back into the space. So we're just starting to see the beginning stages of that now. We've seen some of our peers in the industry announce recently in the last week or two that they're coming back to the table. They're ready to start lending again. What sort of volume they can do, I can't really speak to. What the credit programs are going to look like, what leverage and LTVs are going to look like is going to change day to day, week to week. For us, we're no different. We have been continuing to support our top VIP borrowers that we've been, doing business with for 4 to 5 years. Guys that we know, that we trust, people who, have operations that we believe in. We're going to continue to support those borrowers and slowly start to open back up to other borrowers, but that's largely going to be a function of what investor capital, wants and what the appetite is. I think, things will start to feel a lot more normal sometime around August, September, provided we don't see another spike in, COVID-19 infection rates and hopefully not another subsequent lockdown. But I think we probably have about 60 days or so, 90 days or so before things really start to return to some level of normalcy.
So, and I'm going to ask you that, like, as a broker, if I'm out there and I come across opportunities like this, I come across borrowers, that are seasoned investors, but I've never done these deals before. I'm new to these deals. I come across these deals. How easy is it to work within your system?
Yeah, so our system is super easy. Part of the proprietary technology that we've built has been basically building portals for every counterparty that we interact with. So whether it's a vendor, a broker, a borrower, an investor, whoever you are, you have a portal and login credentials that you can use to basically access our system. So if you're a broker out there and you're coming across a real estate developer that you want to introduce to us for financing, all you have to do is go to our website. There's a big button there that says get financing now. You click it, you create an account, and you can just submit a loan application online. Super straightforward. We do all the work for you. We'll tell you exactly what we need to collect. It's up to you as the broker, whether you want us communicating directly with the borrower or not. Some brokers, are more sensitive than others with relationships, and they want to constantly be in between and make sure that they're not getting cut out, although that's not what we do. We've never once cut out a broker out of any transaction. Even when a borrower has come back to us for repeat business and has tried to go around the broker, we actually loop the broker back in. So you're protected for life. So it's really just a question of how, involved you want to be. If you want to hand the reins over and let us do the work for you, we'll do that. You could focus on finding new business. If you want to be there handling, processing and providing documentation, you're more than welcome to do so.
So let's play that scenario. Let's say I'm a broker. Most of my business is residential, first family residential, owner occupied. Come across a few investor deals, now and then, and and then I come across actually someone who's a seasoned investor, someone not like the doctor actually who's doing fix and flip one or two actually every couple of years, but actually someone, this is their business, and I know actually that they're going to be able to use your platform. But I don't want to actually have any part of that process. How does that work out? Like, how do I protect myself actually in that? And does that happen for perpetuity? Do I keep getting paid on that borrower?
It's in perpetuity. Yeah. So all you got to do is go to our website, make the account, submit the loan application. That borrower, that individual that you're introducing us to, they also automatically have an account made for them. And you're listed on that account. We have a whole, we call it our POC section, points of contact. And in that section, we have all of the related parties listed. So that borrower's attorneys, the title companies they want to work with, the broker that introduced them. If that borrower ever comes back into our system and tries to submit another loan application, that broker is flagged and notified. So You don't have to do anything. You literally just give the contact info. As long as we close a deal with that client, they're your account. The only way that you would ever, as a broker, lose that relationship or that account is if a different broker brought them back to us a second time. We'll never solicit them and cut you out. Or if they do come to us directly, you'll be notified and you'll, be able to say yes or no, stop, don't do this, whatever.
Yeah.
But we'll never cut you out.
That's fantastic. That's a sweet deal, man. That's great. That's great. Listen. It's good to know that there's so many people out there that that just come across these deals once in a while, but they're not experts. And something I believe actually you should focus on what you are an expert in, and know when actually I could pass the baton to you guys and know that you're not going to drop the baton. And I'm also going to be able to share the victory as we're crossing the finish line through actually shared commissions. That's awesome. That's great. So really cool platform. I love actually the fact that that you're focusing on actually the investor. You guys found a niche that you guys are really, really good in. And I guess one last question. Which was the first group to come back? Was it the institutional investors or the cloud investors? What was the first group that started to come back and said, all right, Allen, we're ready to throw you back money again?
Yeah, so it was the crowd and the smaller unlevered institutions. So basically everybody participating on the crowd side. The larger whole loan institutional investors are just now starting to come back to the table. So the crowd came back first.
Fantastic. That's awesome, man. It's great to hear, man. So are you looking forward to getting back to work, getting back actually in the office?
Yeah. Yeah. So I don't get me wrong, I love being home. I have a 1.5-year-old son that the one silver lining in all this is that I've been able to spend more time with him and see a lot of his firsts that I would have otherwise missed out on. But I'm definitely ready to get back to the office and get back to doing what I love. I mean, I've built this business from the ground up, so I genuinely love what I do, and I love just seeing it grow. So.
Fantastic. All right, Allen, thank you so much for taking the time to spend with us. We really, really appreciate it. And everyone, listen, if you're not doing business with Sharestates, please hunt them out, search them out. Great company, great system actually behind them. And the fact actually that you can be someone that does not do real estate investor loans and plug into their system and be able to actually, ride on their expertise, I think is an awesome thing. So, Allen, thank you so much for joining us.
Thank you so much for having me.
And again, everyone, I'm Andrew Berman from NMP and NMP TV. Thank you so much for joining us for our Mortgage Leadership Outlook. Got a great lineup of people that we're working on for next week. We really, really appreciate you taking the time to join us here every day, 4 o'clock Eastern, Monday through Thursday. And with that, we're going to conclude today's broadcast. Everyone, stay safe out there.